Hello and welcome to another session of the Fit Finance Sessions with me, Henry Elliston, and Tim Webb. Tom Senegals is still away, sunning himself somewhere hot and exotic, or he's got back and he's just in lockdown and not allowed out of his house again. We're not quite sure which, but we're hoping he'll be back with us next week. So today, Tim and I have been having a little bit of a chat. We thought what would be useful is to come up with a kind of financial MOT style thing for you to have a look over your finances, sort of the main points. And we've come up with 4 points that we think would be pretty interesting, just to look through your portfolio and see if anything needs amending. And so the 4 things that we're going to talk about today are reviewing your investment portfolio and rebalancing it, as the first one. The second one then actually is away from your investments, but it's the insurance policies that you've got and reviewing those, making sure they're still the right price, but also any trust that you might have set up and your will as well. Then the third one is, let's make sure that the plan that you initially set up is still on track. And we all know curveballs get sent to change things as life goes on. So are those plans that you set out 2 years ago, 3 years ago, 10 years ago still the right plan? Are we still doing the right thing? And then I suppose allied to that, the fourth one would be to decide on whether or not your investments as they are the right ones, whether or not you should be paying some more money into them, or indeed whether or not the money you're extracting perhaps from your pension is at the right level, or whether or not it can be increased, or whether or not it could be decreased. But anyway, so look, in a bit more detail, we'll just rattle through these. And Tim, I think you're going to take over on reviewing and rebalancing your portfolio.
Yeah, for sure. Yeah, so I think there's a good few different aspects to this, but I suppose starting from the most macro or the biggest picture, and then sort of drilling down into the more nitty gritty of it. First things first is the asset allocation. So, i.e., what is this split of your overall investments? How is that managed, and is it right? Any coined investment book would tell you that actually 80 to 85% of any portfolio's return is driven by the asset allocation, i.e., how much money are you putting into the US, UK, stocks, bonds, whatever. How is that structured, and is it still the same? Without actually consistently rebalancing the percentages in those different areas over time, you'll see that actually some sectors will swell and end up taking up more of the pot than you originally intended. So it's a case of making sure that they stay consistent with how much risk you're willing to take, because that is intrinsically linked to how much risk you're happy to take with your money. Cost, clearly, next one. Most people are familiar with this. Clearly, we want to be getting the most returns that we can for the given level of risk that we're happy taking, but also at the cheapest possible level as well. Now, it is a bit of a difficult conversation. There's all sorts of different conversations all the time in the industry about costs and paying for active, passive management, all that sort of stuff. But generally speaking, just for the purposes of this, at least, it's just a note worthy point to make sure that are you paying too much, and relative to how things have been going. If you've been massively underperforming the general benchmark, or your peers, if you like, or the portfolio's peers, and what everybody else is doing, then are you in the right place? There is just because you're paying more doesn't necessarily mean that you're getting better management. But then to the contrary of that, there is also the other side of the fence, which argues that pay peanuts, get it's not as clear as that, but get monkeys type thing. So that's generally speaking the reviewing the portfolio point. Now, number 2 on your list was insurance, and sort of all the ugly stuff in life, really, all that sort of stuff which can clearly happen to all of us. And yeah, in terms of the overall plan, you need to make sure that you've got adequate protection in place. Adequate clearly is a difficult thing to quantify, but largely these things are to do with the material loss to the family or the household if certain things were to happen. So if you were to pass away, you or your spouse, or you were to get something really awful, so a critical illness, whether it be cancer, emphysema, something awful like that, or you were to lose your income, you break both your legs, or you couldn't work for whatever reason, and you lose your income for a sustained period of time, you need to make sure that there's still bread on the table, what have you. So yeah, you need to make sure that those things are still relevant. If you've changed jobs, for example, and you've lost that death in service, that high so mighty death in service policy that you had through work, or the really nice PHI, the income protection that work offered, and you've lost that, clearly, that's the hole in the plan which you need to fill to make sure if the worst were to happen, then you've got something there. But similarly, obviously that's whilst you're alive, so protecting whilst you're alive, or not in the case of life cover, clearly. But wills, trust planning, all that sort of stuff is all about the better direction, or your intended direction of your assets, making sure that is what you want them to be on your death, but also the protection of those assets as well. A will is quite simply a piece of paper that will just direct your assets where you want them to go, but it won't protect them sufficiently from other bits and pieces in life, such as divorce of the recipient and all that sort of nasty stuff, which no one likes talking about, but unfortunately, as we all know, happens. So yeah, they're the first two points on the list.
But I think they're really good. I think the only other one I'd add to that is, if you were a dirty, filthy smoker and you stopped smoking, of course, those life insurance policies and critical illness policies that you would have had set up all those years ago with smokers' rates on them, you can now get them. You get redone with much lower rates just by showing that you're a non-smoker and have been for at least a year. So certainly, if that's anyone out there, then get a look into your life insurance plans and the cost. The next two on the list, then, so we're looking at checking the plan still relevant for you. So for a lot of our clients in particular, we create financial plans for them that take into account the various things that we imagine might happen at the point that we write the plan. And of course, we never know whether these things are going to happen or not happen. So some of them might be that the children are going to go to private school. It might be that I'm planning on retiring in 5 years' time, and then I'm going to buy myself a great big chalet in the south of Spain and a boat and sail around the world. But of course, when all these events happen, they might change, and it might be that your child ends up getting a scholarship to the private school, so the fees don't cost you as much as you were expecting, or that actually you go and have a look around the properties in the south of Spain, and you go, actually, I don't really want to do this. Instead, I'm just going to go on holiday in Cornwall. And so all of a sudden, that money that you had set aside for that purpose is no longer there. And of course, it might just be that your investments have performed better or worse than you would have expected. And so that gives you bigger and better options, or perhaps worse options than you had initially set out. And so it's going back and reviewing your plan, reviewing what you're trying to do every year. And then certainly if you've got a cash flow forecast, building it back into that cash flow forecast to make sure everything is still going in the right direction, and there's nothing that's been overlooked, or there's no more opportunities out there for you that you could have enjoyed, but you didn't think you were going to be able to enjoy 3 or 4 years ago, but actually now it seems that you can. And then I think associated to that, the final piece, is when we build the plan, is to then say, actually, life is looking much better than I thought it was going to. And so now I can afford either to invest a little bit more money in my ISAs or my pensions, and we can work out how much would be a sensible thing to invest. Or it might be that you've retired and now you're drawing money out of your pension. And so now you can work out, well, actually, I was only drawing £1,000 a month out of my pension, but actually, now that I've been back and reviewed everything, it seems like I could probably draw out £1,250 from my pension, perhaps, or. So I think that's from the sort of the overarching level of reviewing your portfolio and finances, and how best to ensure that you keep on track. And there's no harm in running through this list on an annual basis. And indeed, if you employ one of us, we will be doing these 4 checkpoints for you and for your financial planning now and into the future. So I hope that all made sense. I hope there's some useful tidbits there for you. If you've got any comments as ever, please do let us know. And until next week, goodbye.